the key emphasis that was taken away is higher for longer. So the expectation that rates are likely to remain at their current level or even slightly higher for longer than the market was anticipating. The Fed have been raising rates obviously all year. And at the same time, the market had continued to price in that rate cuts would come pretty soon, even the end of this year into the beginning of 2024. And I think what was really clear from the message on Friday that's not the case. And in fact, we saw that feed through into the forward pricing, where rate cuts are now not expected by the markets until June 2024. So I think the key message to take away is definitely higher for longer.
And just bringing it back to the near term, between now and September, what are the most important metrics or releases that investors should be focusing on?
Well, obviously anything that's around that core inflation data, because while the headline inflation has been coming down, there are still some issues around some of the core numbers. And feeding into that, of course, is the resilience of the labour market. So the US labour market has been ultra tight all year, and you start to see some softening in that. And that's really the balance of what the Fed are looking at is, are the interest rate rises having an impact on the economy, and particularly within that labour market, or can they afford to tighten further through the rest of this year?
Jackie, does it actually matter to the markets whether the Fed goes for another 25 basis point hike? I mean, the messaging has been so consistent now for the last couple of months that we are very close to the end of the road when it comes to this rate hiking cycle. We might be there, we might not be there. If they do, maybe there's one more 25 basis point hike to go. But will it affect the path for risky assets if they do go for one more?
Yeah, because I think there's also a question about the credibility of central banks in general and their ability to have this balance between controlling inflation and not impacting the economy too much. And if you remember back to 2 years ago, where the Fed absolutely were focused on the message about inflation being transitory, which obviously turned out not to be the case, and it does really impact credibility. And if the central bank's credibility is questioned, that absolutely impacts appetite for risk assets.
And when we talk about the Fed keeping rates restrictive, for how long are you expecting them to actually keep them in restrictive territory? Are they going to wait until headline inflation gets to 2% before they start thinking of shifting rates down, or can they afford to do that before?
So it's an interesting question, because what's sort of buried in that question is, what is the sort of neutral rate of interest? At what point is the absolute rate still restrictive, or is it neutral? And that actually came out on Friday a little as well, but Powell was unable to clarify what he saw as that neutral rate of interest, where it's neither expansionary or restrictive. But certainly from the market perspective, as I say, there's an expectation that these rates will remain at these sort of higher levels through into the middle of next year. And even though those rate cuts are then being priced in, it isn't substantial. So again, I would just reiterate the message of higher for longer, and not to sort of expect that the Fed will start to cut soon.